Welcome back to The Long-Term Investor. Today, I'm thrilled to be joined by Vanguard's Kevin DiCiurcio, who has a very long title, Kevin. We've been talking about this in advance, but when I asked you to come on the show, the real reason that I wanted to speak with you in front of our audience is that you're in charge of the capital markets research and helping develop those models that put out the return assumptions that many advisors like myself, and I suspect many individual investors, see at the beginning and the middle of the year. So Kevin, welcome to the show, and tell the audience, maybe in a better job than I have, exactly what it is that you are doing at Vanguard.
Well, hi, Peter, and thank you so much for the opportunity to be on your show today. And as you mentioned, my name is Kevin DiCiurcio, and I am a research team leading a global research effort to inform on our capital markets outlook in our investment strategy group. And sort of our bread and butter, of our research is the research and development and operation that we run, which is the Vanguard Capital Markets Model, which is a financial simulation engine that is projecting global asset return distributions to help inform on economic and market outlook, as well as kind of understand portfolio construction implications. So this is an important part of the research we do, but we also have a broader strategist function, within our group, which is really about making sense of what's going on in markets. And, we may not be able to predict what's happening tomorrow, but I think a lot of our job is kind of an attribution of an understanding of what has happened, to help our investors, maintain discipline with their long-term investment approaches.
Well, when I reached out to you, you and I spoke, we were trying to figure this out, I don't know, maybe 4 or 5 years ago. And Plain Corp, we update our capital market assumptions every year. Actually, the episode just before this one goes exactly through that process. But while the process doesn't change that much, we do go a deep dive into the process itself and make sure that the process we're using is valid. But let me look at Vanguard's. So I reached out right when I saw the numbers come out. Maybe you could share a little bit with us, like, how do you develop these assumptions, these return assumptions, and how is it that you are hoping that people use them?
Yeah, absolutely. Well, I thought maybe I'd start, by setting some context and definitions. I don't want to lose your audience at the start with, using any kind of insider vernacular, but you'll probably hear me refer to the model as VCMM, throughout our conversation today. Acronyms are very widespread at Vanguard, and it pretty much kind of rolls off the tongue at this point. But VCMM stands for the Vanguard Capital Markets Model. And, as I previously mentioned, it's a global asset return forecasting simulation engine. It's really become an integral tool for outlook and portfolio construction considerations that are used across the Vanguard enterprise. Our capital markets research team sits in the investment strategy group, and we, as I said, own the research, development, and forecast operation of the model. We're also the gatekeeper of the model use. So we advocate and enable clients to use VCMM in primarily 3 ways. First is really encouraging clients and advisors to set reasonable asset and portfolio return expectations. Investors have myriad accumulation goals, most importantly, retirement, for most, but also college savings, other general savings goals. And being able to set reasonable return expectations is important information to really facilitate the success of saving and investing. So in the VCMM model, from a kind of a high level concept, we're leaning on statistical predictability to set these return expectations. And this concept of predictability simply means that our belief about future returns varies through time. It doesn't mean that asset returns lack uncertainty, just that there's information that exists today that informs on a pattern of returns in the future. I think a useful analogy to describe this is seasonal air temperatures. We may not know exactly what the temperature will be each day throughout the winter, but we do know that winter days on average have a lower temperature than summer days. So similarly, throughout history, intermediate to long-term equity and bond market returns have had quote unquote seasons, and these can partially be explained by starting market valuations. So therefore, these time-varying returns projected by VCMM give clients a good framework for understanding whether they should consider saving more, spending less, perhaps changing their asset allocation risk posture in order to give themselves a best chance to achieve those accumulation goals. A second important use case is really VCMM has become an important portfolio analytical tool that helps our clients understand the risk and return trade-offs of their investment decisions. So our first point here really relates to the previous one about setting reasonable return expectations. But because we all invest under uncertainty and ultimately are compensated for that uncertainty, understanding the likelihood of meeting your savings and investing goals really requires a full appreciation of the range of potential outcomes. So VCMM, being a globally connected model, captures statistical relationships among global asset return drivers, simulates them jointly, meaning we're really trying to capture, correlations and kind of higher moments that make this a really important portfolio construction tool. So this is used in advice settings at Vanguard to quantify probabilities for achieving success, given personal information about savings rates, asset allocation, retirement age, etc. And we also have portfolio analytical users who will use VCMM simulations to get insight into how the range of their potential return outcomes or probabilities for downside risk events change based on changes in risk taking in the portfolios. So I would argue that this type of analysis is also useful in revealing preferences about one's own risk tolerance. We can show you a comparison of your projected risk and return profiles between an 80-20 stock bond portfolio and a 60-40, and you may just decide that you're a little bit more comfortable with that range of potential long-term outcomes or the downside risk expectations in the 60-40 to the 80-20. That reveals a risk tolerance. So analytically, outlook reasons, those are the first, two primary use cases. And lastly, what we're using more and more of is VCMM is being used in asset allocation frameworks that will now provide recommendations for the portfolio mix. And, really briefly here, we offer valuation conscious portfolios whose allocations will change through time in order to anchor to either a long-term return target or to help you stay more consistent with that preferred risk and return profile. And then we also perform due diligence on static portfolios and glide paths, based on, what we call the equilibrium kind of premia assumptions in the model.
Well, I will add one more use case to that, Kevin. I feel like I use it to behaviorally coach my clients to stay the course on their diversifying asset classes, particularly in the last handful of years where US large cap stocks were just beating everything on the planet. And a common question is, well, why do I even own international? And I could often point to Vanguard's 10 and 30-year projections to say, well, look, they're forecasting, and there is a range of outcomes, but they're forecasting them to be higher. I am going to get into some of those numbers a little bit later, but I actually would first love to hear a little bit of an insider's look on the process of developing these numbers in the first place.
Yeah, sure. And I appreciate your use case. I think that's a really informed and educated use case of VCMM. I know we spoke, a few years ago. So I appreciate, the work that you're doing with your clients as, as we think about using the capital markets model to benefit, a wide do-it-yourself investment audience and an advised audience. So, in terms of the process, so we have a 10-person global research team responsible for the research, development, and operation, as I mentioned. But we're also we have governance from internal operational risk teams. Given the kind of widespread nature of its use, we have a lot of governance oversight from operational risk teams, audit teams, as well as internal oversight from our regional and global chief economists, and who are really weighing in with opinions on model methodologies and the forecasts that we're releasing to our clients. The forecast operation itself is really designed to be as systematic as possible. We re-estimate the model quarterly as new data is finalized, and we will run forecasts monthly based on those prevailing market conditions. And, we try not to touch it, right? There is no kind of ad hoc overlays. A lot of that, we try to build into the model methodology. But ultimately, we generally release a new long-term outlook each quarter. But in the event of volatile market conditions that are creating big impacts to the forecast, we'll certainly share updates intra-quarter, through our corporate communications teams or strategic communication teams internally. But ultimately, forecasts will change only as market conditions change, forward-looking information changes, or model methodologies change. So the research development effort really is separate from operating the model on a monthly basis. Any methodology changes or changes to forward-looking assumptions resulting from that research and development effort, that's then part of a broader, new model implementation and a change management process.
And so any model development is only as good as its inputs, but in my understanding, it's a very probabilistic approach. Is that a fair assessment?
Yeah, I mean, the goal of the model is to capture the full range of potential outcomes. Absolutely.
And there are so many capital market assumptions that are made by large financial institutions, again, by financial advisors who then need to populate financial planning software with capital market assumptions. Would you mind just quickly touching on maybe some of the different approaches that you did not take that others maybe take in the industry with capital market assumption development?
Yeah. There's primarily, I think a couple ways to do this, and then maybe a lot of ways on the how. A lot of the forecasting really goes back to, some of the kind of original Robert Shiller, CAPE work that identified this inverse relationship between, starting market valuations and future returns, right? So there is this kind of predictive regression approach where you're really just mapping a starting condition to a long-term return and kind of visualizing that scatter plot. That's where the predictability came from. But from an explainability perspective, right, there's that asset pricing aspect to this as well, where any financial security, right, is getting its returns from two sources. You have an income return and you have a price return. So you're kind of starting with this accounting identity, and then from a asset pricing perspective, like thinking in terms of discounted cash flows, that income return on an equity side is coming from dividend yield, and your price return can be decomposed into its valuation change, and then the growth in the fundamental that you're using that valuation. So a lot of approaches, you see the sum of parts where, you have you're making an informed view, maybe independently on, okay, dividend yield is today 1.5%. So maybe I'm looking at a historical average there. Or maybe I'm just locking in the current condition. Valuation change, maybe my expectation is there's some reversion to a historical average there, so that you're kind of just computing that impact to return, based on some assumption of what valuations are going to do. And then, earnings growth, you see a lot in literature, historical averages. It's kind of hard to find predictability there. We may dispute that a little bit, but I think you have some combination of these two approaches of kind of predicting based on mapping current conditions to a future return, or making some decisions on those sum of parts. So I think where we are is we're taking advantage of this academic literature of predictability, but we want to give that explainability, but we kind of want to model it holistically. And I think that's where maybe the approach is a little bit different, is we're taking any ad hoc nature out of views on these sum of parts. And but I think you're kind of limited to these kind of ways of looking at it. And then otherwise, you can just say, look, historical averages. I throw my hands up. I don't know what returns are going to be. Historically, they've been 10% in U.S. markets. But I think, what we're trying to do is, again, statistically capture predictability, do it in a consistent way that, we're not heavy-handed making a lot of assumptions in the model while we're running it, and that, it is statistically capturing the full range of outcomes. So, I think, again, it's not a different way of thinking it, but it's more of a holistic, consistent, systematic model is what we're trying to achieve.
Well, let me zoom out to kind of the end result. And if you're listening to us on the podcast, there's no way for me to really showcase this without saying it. Although if you're watching us on YouTube or you're watching us on Cheddar, you go to the longterminvestor.com and you can get a better look at some of these returns. But Kevin, what I'm doing right now is I'm looking at the 10-year forecast. I'm going to start there. Maybe we'll go to the 30-year. And what you showcase are the 5th percentile, 25th percentile, 50th, 75th, 95th. So you have your normal distribution.
Mm-hmm.
And I'll try not to keep it too wonky for our listeners who don't want to talk stats. But if we're going to look at the 50th percentile outcome as sort of our base case, you have, over the next 10 years, U.S. equities earning an average annualized return of 3.8%. Developed international, you have 6.3%. I think, interestingly, you have bonds at 4.3%, so outperforming U.S. stocks. When you're looking at these different percentiles, though, if I go out to the 95th percentile, well, yes, if equities are in their 95th percentile, they end up beating bonds. But when you showcase those percentiles, Kevin, how is it that you are thinking that people are going to be using those percentiles and thinking about them?
Yeah, that's a great question, Peter, and happy to try to and shed some light on this. But these are the percentiles are used to describe that full probability distribution, which is generated via a sort of a deterministic regression approach, and then simulating all of the uncertainty in the model. We don't have to go deep in that. But so what we have here is this kind of full probability distribution function that we're summarizing in these percentiles. So, I mean, there really is this literal interpretation here is like if you're looking at the range of outcomes between the 25th and 75th percentile for US equities, for instance, that has the interpretation of there's a 50% chance of returns at the end of the 10-year horizon falling, between that return range. The nuance, I think, in VCMM is that there are time horizon implications, though, to the interpretation of model medians or the model averages, as you've pointed out. At around the 10-year time horizon for equities, and maybe it's the 5-year for broad market or intermediate duration fixed income, we do have this kind of increased confidence in the model's ability to capture realized outcomes, somewhere in that middle 50 percentile range. That's why we really define the median returns at those time horizons as return expectations because of that increasing accuracy in the forecasts. If you were to look at shorter term distributions, which we don't really share publicly because, again, we want our investors to use them properly. So we're thinking about the long term because I know, we know investors are fixated on that 50th percentile. That's the average. That's the return expectation. But for the more shorter term time horizons, basically what we see in the model is a much more uniform distribution. You're kind of equally likely to get any return between negative 20% and positive 20%, for U.S. equities over the next year. And therefore, we have less confidence in saying, okay, well, the median is a return expectation. It's just not as accurate. So as a research effort, what we try to achieve is really the best forecast accuracy to set those return expectations over the median in the long term. And then over shorter term time horizons, we're really aiming to ensure that VCMM can capture realized outcomes somewhere in the distribution. So, I think the 2022 experience was really instructive for us in this regard. So, you probably remember 2022 fondly, the beginning of the year. We kind of had January 2022 was the beginning of this kind of steep decline in U.S. equity markets over the next 9 months or so that coincided with a rapid rise in long-term bond yields as kind of we experienced that inflation spike and Fed signaling an aggressive hiking campaign. This caused simultaneous capital losses across both markets and the notorious spike in the stock bond correlation. Equities were down near 25%. I think bonds were down 15, aggregate bonds in the US market. So we kind of looked at this, are we capturing this in the model? So a 40-60 US stock bond portfolio, and I'm doing a conservative one because, how frequently have bonds, had a 15% drawdown in 9 months? I mean, it's almost unprecedented, the aggressive hiking campaign that we saw. But the 40-60 US stock bond portfolio was down by 19% over those 9 months. And so we went back looking at the forecast produced as of December 2021 conditions. For VCMM projected a 19% drawdown of the 40-60 portfolio, somewhere around the 95th percentile of its kind of max drawdown, projections. So, in that case, we felt like we reasonably well captured that outcome. So, in other words, with these percentiles, VCMM's designed to set return expectations with the median or the averages of the model from the long term. That's where you're fixating on that 50%. But we really want to fully describe the probabilistic nature, of returns over all time horizons.
And I'll take a moment to explain to people why I think this conversation is interesting, particularly if you are a client of a financial advisor running Monte Carlos, or you are a do-it-yourself investor who's using modeling, is that sometimes you might be worried about something bad happening in the market. And the modeling process takes into account, you mentioned 2022 was in the range of expected outcomes roughly. And I think the mistake people make when they're trying to set up return forecasts, particularly when they're for 30 plus years, is they forget, well, if we're going to have these modeling, it doesn't mean that return you're assuming you're gonna vary it and put a standard deviation on it, it's going to capture downturns of a similar magnitude and frequency as we've experienced in the past. Mm-hmm. And I'm kind of curious, Kevin, when you click over from the 10-year returns to the 30-year returns, mm-hmm. 30-year returns hug the average pretty closely over the long term. So I guess does the fact that the long-term average, does it get a bigger weighting in the model and thus drag returns closer to their long-term average?
Such an interesting question. And, what we see, the way the model, and I don't know if you have questions on this, but the model really has two important states, right? The first is kind of the predictability that we described, where we want to capture the impact of current market conditions on our expectation of the future, and then we let the statistics in the model tell us how long that takes, and we're not as concerned with the path sometimes necessarily, but more it's how long do these relationships with starting conditions tend to play out? Trend growth rates, matter certainly as well, in that time horizon. When we think about the very long term, we do have this kind of equilibrium aspect of the model, and you can kind of consider equilibrium as, this is when market conditions would have no impact on our return expectations on the medians, right? So if we're looking at sort of this steady state. So you can think of steady state as maybe years 21 through 30 in a 30-year forecast. Maybe you want to go a little bit further and say, maybe it's 31 to 40. In that state in the model, right, there is, initial conditions have decayed off and you're kind of left with these long-term premia assumptions. So there's a big body of research where we're kind of looking at that and saying, okay, well, what's our, long-term, what have long-term averages been for, country equities, and how should we position that in the model? Not going to get into that in this question here, but the relationship between the two matters on time horizon. So our 10-year forecast is almost entirely determined by current market conditions, and then you kind of get to this 30-year horizon, and in most normal times, your 30-year horizon really resembles that equilibrium set of assumptions, right? It's not going to vary that much on it, but depending on how extreme current market conditions are, they can begin to start dragging that higher or lower. And I think in the case, you have them in front of you. I presume that our 30-year forecasts are drug down. I think our steady state assumptions are around 8%, which is different than the 10% that we've seen historically. There's reasons for that. But we think where current market conditions are today, have a big impact on even the 30-year time horizon.
Well, that's an interesting point we can pivot to. Over the next 5 to 10 years, what does Vanguard see as the strongest risk return profiles based on your modeling?
Yeah, so I would encourage, I don't know if you're a reader of kind of the economic and market outlook work, Peter, but I would definitely encourage you and your listeners to read the report that we published in December. That'll probably lay out all the numbers, the rationale, economic rationale, and maybe statistical rationale for those numbers as well. But ultimately, we continue. We think long term, so things tend to move fairly slowly. We're considering bigger picture things, mega trends, being one of them. But ultimately, we continue to see strong value in fixed income. Expected equity risk premium, which I often estimate if you're kind of looking at those return tables, but looking at the difference in the median 10-year forecast between broad equities and broad bonds, that is my estimate of expected equity risk premium. It might be different than how some others look at it, but that's based on our forecasts and based on the kind of that statistical probability. That's very compressed by historical standards. So this suggests that over the long term, we do not believe that global stock bond portfolios are really expected to receive adequate compensation for taking on marginal equity risk. And this is particularly related to the U.S. exposures. In that VCMM equilibrium state that I described, where you're kind of not impacted by market conditions, when we look at, credit risk, within the fixed income space, it's, credit bonds in equilibrium provide really reliable risk premia over the long term. So we can actually make this argument from like a strategic equilibrium perspective. You want additional credit bonds in your portfolio. But given the spread compression that we've seen in both IG and high yield spaces, we just don't think that risk return trade-off is as attractive today. I would argue that to really capture the benefit from your fixed income exposures, you want to be up in quality, treasuries, really high grade investment grade bonds, if you're going to be taking that credit risk. From an equity perspective, we again continue to believe that U.S. value provides more attractive prospects than U.S. growth, and this is even in consideration of different AI scenarios playing out. Whether it's an AI-led growth boom or if AI disappoints, we actually think value performs well relative to growth in both cases. And kind of let me lay that out. In the boom case, we think value outperformance is mostly driven by create creative destruction processes in which competition for the AI profits begins to erode the excess profitability that we see today in kind of a handful of firms. Other sectors in this kind of AI boom will start to experience profit growth as well, and then some of these productivity gains really show up in consumer surplus as well, right? So they're not always materialized in profits in a handful of firms. And so, the broadening out of profitability and the erosion of excess profitability, we think is a strong case, continued for U.S. value. If AI disappoints, it's a different reason, but that's kind of when the profits don't materialize from the heavy CapEx expenditures, and those handful of hyperscalers driving the tech performance today will likely underperform in that situation. And certainly given their large share in the market, that has puts pressure on the broader market as well. From a global equity perspective, and you mentioned this before, we know the history here quite well. The U.S. equity market has trounced its global peers over the last decade and even longer. When we look at the joint probabilities of the model, and this is a use case that we haven't always talked about. I mean, if you're comparing the medians of two asset categories, it doesn't give you all of the information of kind of the joint probability. So when we actually do this joint probability, the VCMM model shows about a 35% probability of continued U.S. equity outperformance, which by just looking at the differences in medians, you might get the false impression that, okay, we believe 100% that, developed ex-US, for instance, is going to outperform. But 35% is it's a non-trivial probability. And it's mostly related to kind of the growth challenges that we've seen in the ex-US markets and the economies. But really given the level of US valuations today and our view that, a lot of that, our view of overvaluation being driven by, this increasing expectations for expanding, corporate profit margins, earnings growth rates. You kind of see this in analyst consensus estimates. We just see that a very low probability of being able to be sustained and increasing those growth rates over the long term. So, from a risk return profile, we definitely favor developed ex-US. But in the event of long-term US outperformance, we just don't believe it can possibly be at the magnitude, as the last decade, right? So that 35% probability, if you kind of look into that, the very few of those simulations have a 10% outperformance, of US there. So, to your point earlier, we don't believe you're going to be penalized from holding a balanced global equity portfolio, as was the case maybe the last 10 years. So when we look at that forward looking, we still want to stay balanced with our global equity portfolio.
Well, I got to be honest, Kevin, I had my first client conversation since, I don't know, the early 2010s, where, in the late knots, so like 2007 through, 2012, clients would keep saying, like, why do we have so much US? We should have more international. And ever since that, and, at that point, US had started winning, but the sentiment was still there. And for a decade plus, it's why do we even have international? We should just be all US.
Yeah.
In 2025, I had my first client conversation where they were ready to move from US to international. And while I was thrilled that I maybe get to talk about something, I also was a little discouraged, like, oh no, we're going to just performance chase the other direction now, aren't we? Maybe different people, but that is human nature for you. You mentioned some of the AI stuff. I was going to ask you that anyways. A lot of the economic report incorporates ways to think about AI-driven returns and growth and how the winners of AI aren't just big technology. You've already touched on it a little bit, but before I move on, I don't want to, if there's anything else you want to mention related to AI, I kind of want to give you that space to do so.
Yeah. And, a lot of this, it results from, I don't know if you've seen, Joe Davis, our
Sure.
Chief strategist, chief global economist, he started this, modeling and thinking about kind of these mega trends, how these mega trends in his mind, will play out in the future. And, it really emerged was this new modeling effort, we're calling the mega trends model, which has been a collaboration across a couple different research teams in the group, but really kind of understanding the probabilistic future of, I think he really started with, the consensus believes, we're going back to this kind of mid 2000s, low growth, or moderate growth, low inflation environment. That's the consensus. So I think he was really setting out to understand, we have this AI phenomenon that's emerging. We have demographic and fiscal challenges. Can I get a better understanding of these mega trends? And what he found was really that this kind of likelihood of going back to this moderate growth and low inflation is really unlikely. And it's this tug of war between those two polar things, which is this AI-driven productivity boom, or will deficits dominate and demographics dominate, leading to a quite different situation. So I think we spent a lot of time in the report really talking about the AI-driven because we should be. It's what's really important right now. And I think we lay out really three scenarios, in the outlook. We have this with kind of a probabilistic, approach to it as well. But I would say the extreme bull case, which is what we see as having a relatively low probability. This is where kind of AI, its economic transformation even is stronger than expected. And this is probably that kind of continuation. This is that kind of 35% US outperformance probability, maybe a little bit lower with the magnitudes. But, I think, our economics team is kind of laying this out as maybe a 10, 15% probability. I'd have to go back to the report, apologize for not having that number handy. But this really results in earnings growth, 8+%. Equity valuations kind of in this type of environment, remain at present levels or even marginally expand under those conditions. So, we think in this environment, U.S. equity returns really would continue to be very strong, around 10%. But the baseline view, that baseline view is where we're assigning most of the probability. And that is really the belief that AI will emerge as this general purpose technology that, is innovative across the economy. And this results in a productivity boom that generates, I think, maybe 3% real economic trend growth rates. But it's really this case where I describe that, earnings growth remains strong, but this is where the competition for profits and creative destruction, consumer surpluses processes I described, kind of normalize that excess profitability. And that's, we just think that's going to put pressure on valuations, at some point, in this kind of mega trends future. So that has equity returns in that 5 to 7% range. And then we have the bear case, and this is this non-trivial probability of AI disappointing. And this is a scary case. Broad earnings growth at this point is looking like trend GDP growth, but with valuations priced to perfection today, we just think they would fall markedly. And this is the scenario that kind of gets you to that decade ended 2008, early 2009, which valuations have a long way to go, which creates this drawdown as well as a long-term maybe 2% annualized return. So. When you think of VCMM, as we connect this to the megatrends thinking, VCMM today is really this kind of probability weighted average of those scenarios, which is why we're in this 4 to 5% range for 10-year U.S. equity returns over the decade.
The other topic that seems to come up a lot these days, although I'm pausing because it seems like it has been coming up throughout my whole career. But at the moment, I get a lot of questions about geopolitical considerations. How does that impact the way that you guys both model returns or think about the inputs?
Yeah, I mean, you follow markets, it's probably as much as I do, if not more. Clearly prices in the short term move on headlines and they move on, geopolitical considerations, wars, political environment, et cetera. And, I think, when we think about it, we don't have a specific geopolitical factor that kind of enters this kind of core macro financial model that, those are sort of the drivers of our asset return. So there's nothing geopolitically that will, aid in this deterministic 10-year forecast. However, I think when we think about the longer term, we think about that steady state that I described. We spend a lot of time kind of looking at long-term average returns. There's some great resources on this. But when you look at long-term, like really long-term, 80 years, decades, over decades, historical average country returns, what you're going to see is like Australia equities, for instance, will have a higher average return than most European countries, over 80 years annualized. So a naive time series model, we didn't talk about this much today, but a time series model wants to converge, to the sample average. So, what we do in VCMM is it's always been a mean adjusted model. We've done different things with that today to make it more dynamic and systematic. But whenever we think the expectations for the future will not resemble historical averages, we can make these mean adjustments. Think of declining inflation rates since the 70s. Think of, risk-free rates, which is sort of a component of that. We're really not letting those experiences inform, what the Fed is trying to do, with inflation, right? That's kind of why we have a 2% inflation average in VCMM in steady state rather than, something that looks more like history. When we do this for risk premia, I kind of mentioned comparing Australia to Europe, once the model kind of converges to that, point where initial conditions don't matter anymore, you're left with that return advantage. So if we just kind of left it naive, we would have, starting at about year 15 or 20 in the model, we would have this Australia expectation for Australia outperformance over Europe. But then when you really kind of consider the history, there was a world war fought on the European continent, and there was two if you go back even further. So, we just think that very may well have explained, why you get these average return differences. So for us, we're not trying to pick equity winners over the next 80 years. We're really just relying on that kind of nearer term predictability. So even though there's not this deterministic forecast geopolitical consideration, I could kind of suggest to you that, these kind of play into our thoughts on long-term risk premium for sure.
So a few questions I have kind of to wrap us up, although neither of them may be all that short, but I guess, are there 2 or 3 or 4 signposts that you would be watching in 2026 that would most change your conviction around the modeling, or, cause the greatest change to what you've projected, at least as of right this moment? Kind of thinking about those current market conditions that you said play a heavier weight on the 10-year returns as opposed to the 30-year. And I'm putting you a little on the spot here.
Yeah, no, I mean, I think for us, Peter, at this point, it really, because you continue to take this long-term view, I mean, there's an element of, our economics research team, which are peers of mine, we work in the same group, they do not have a view on recession or, low probability view on recession in 2026. So for us, I mean, we don't want to talk out of both sides of our mouth, but in the long term, we kind of believe in this lower average return environment. In the short term, we believe there's a lot of momentum reasons why, U.S. equity and U.S. stock market can continue its good performance. So it's sort of like the probability distribution in the long term may not resemble the one in the short term. But as we're thinking again of this longer term time horizon, I think for us, Peter, it's really views on how these megatrend scenarios play out, right? Are we getting increasing or less conviction in AI as a transformational economic tool? Is it a boom? Is it electricity, or, is it something else? I think these kind of probability weights, to those scenarios, I think that's what's most likely going to inform, bigger changes to our long-term U.S. equity outlook.
And for 2026, as you think about what the research agenda at Vanguard will be, or maybe you already know, given that it's already January 2026, what is your team looking into right now?
Yeah, I mean, that's a good question. I mean, I think we have a focus on a couple of things, enabling kind of multi-asset portfolio decision-making. So there's always an element of the work that we do to ensure that we're meeting the demands from our clients on, adding new asset coverage, adding countries to the model. And then kind of on the other hand, I mean, I think there is this view that the way we talk about markets and economy, is tightly connected, right? So I think that's kind of, I think what you could see, from our research agenda is, we want our forecast methodologies to kind of be megatrends aware. We've gotten a lot of insight into kind of the probabilistic macro and AI future. So, we want to make sure that we're connected to those views, and as well as being very consistent with what our economics research team is saying. And I think, as their views on policy, inflation change, we want to make sure that's well represented in VCMM. So that's really this tool that, yes, it helps strategic decision making, but also kind of cyclically consistent, with the viewpoints, coming from our economics research team. And then, ultimately, it's an agenda to help our investors and clients, stay disciplined with their investment approach. So I think ambassadorship is another big thing that we want to do. We want to be talking to our clients. So in addition to the rigorous research and statistical modeling, we want to have these conversations with clients just, to ensure we're helping with our mission of giving, every investor the best chance of success in what they're trying to accomplish.
Well, Kevin, It's always a pleasure speaking with you. We get to have a wonkier conversation than my typical everyday conversation. So this is really fun for me. I'll be sure to link to the outlook in the show notes at thelongterminvestor.com, where you can also find some of those return assumptions that we were referencing throughout the process. And I would encourage listeners and viewers, if you think that you're doing research and modeling, predicting the market, just listen to what Kevin and his team are doing to put all of this information into a long looking forecast. And I use that word forecast lightly because I know that you don't feel like you're predicting the future. You're very good about producing ranges of outcomes. You are arguably the first major financial institution to publish financial outcomes. And it's part of what I've been drawn to all along. And so whether you're an advisor or an individual investor and you can make your way to Vanguard, they really have a lot of great stuff for you to learn from and help set those expectations. So Kevin, again, thank you so much for joining me here on the show. And I cannot wait to talk to you again soon.
Peter, it's my pleasure, and I'm grateful to be here and having the opportunity to address your audience. So I couldn't be more thankful of your time. So thanks again.
My pleasure. Take care, everybody.